Tonight, we will be looking at the US labor market. This is the first in series of videos on this topic and will serve as a baseline overview. So what is a labor market and how does it function? From the standpoint of federal employment statistics, employees are those who can and are able to work and are either working or are actively seeking work. These are considered the labor supply of the economy. The other side is labor demand, or the jobs available through employers. These supply the wages that financially support employees in return for their work. As shown on a supply and demand graph, these two numbers move inversely to one another. For instance, when there is an increase in labor demand, there are more jobs than employees to fill them. Employees can be more selective of the jobs they choose, given the higher number of options. Employees who are looking to change jobs feel empowered to shop for these options, and overall wages increase in an effort between employers to compete for the available supply of workers. When labor demand decreases, there are less options for employees to choose from. This makes employers able to be more selective when hiring, as there are more applicants than open positions. Because of this, the overall number of people able to find jobs goes down, and the need to compete for applicants goes down as well. In this environment, employees are generally disincentivized from looking for new jobs. Wages thus fall along with the reduced demand. You can see the same result when there is an increase in labor supply, as there are more workers than available jobs, and the same downward pressure is applied to wages and overall employment. On the other hand, a decrease in labor supply has the same effect as an increase in labor demand, as employment and wages both rise. These four variables can be summarized in two basic labor market states: tight and slack. A tight labor market is considered a labor shortage, or could be called a seller's market, with employees selling their labor at higher demand. A slack labor market is considered a labor surplus, or could be called a buyer's market, with employers buying labor at a lower rate. The US Federal Reserve, or the Fed, attempts to control the total amount of employment in the overall labor market following their dual mandate. This means they are trying to achieve two objectives at once: maximum employment, or everyone who wants a job has one, and low and steady inflation, meaning prices are very gradually drifting upward over time. If unemployment is high, or prices are rising or falling dramatically, then the Federal Open Market Committee, or FOMC, may intervene. FOMC is a committee within the Fed that directs short-term monetary policy. They use the federal funds rate as the mechanism to shift the balance one direction versus another. The change in federal funds rate directly impacts the prime rate, which is used for bank loans and credit card rates. This in turn either stimulates spending or represses it, which has a countervailing effect on employment. The dual mandate can be illustrated as a supercycle consisting of an easing cycle and a tightening cycle. When unemployment is high and economic growth is weak, FOMC will implement an easing policy to cut the federal funds rate. This cut stimulates borrowing, which allows businesses to invest in growth. This leads to hiring and capital expenditures. Increases in hiring make employees more in demand, and wages then go up. When growth is high, wages are high, and unemployment is low, consumer prices tend to increase upward. The ideal rate of inflation, or the rate of price increases, is considered to be around 2% per year, as measured by annual changes in the price index for personal consumption expenditures, or PCE. So if inflation becomes much higher than this, FOMC will implement a tightening policy to increase the federal funds rate. This slows down investments as the cost of borrowing is higher, which reduces hiring. Employees become less in demand, and thus wages decrease. Inflation as a whole decreases as prices stabilize. So the theory, as shown by the Phillips curve, is that there is an inverse relationship between inflation and unemployment. If inflation goes up, unemployment goes down, and if inflation goes down, unemployment goes up. Consider how this works in theory. If unemployment is low, then that means there are generally more jobs than people to work them. This causes wage competition and inflation, meaning the prices companies pay for employees is higher because there are less people on the market to fill open positions. With wage inflation comes cost inflation, and then price inflation, where now the workers pay more for their own goods and services. If inflation goes too high, the cost of living can rise faster than wages. This causes a drop in demand for goods and services, which can slow down the economy and lead to reduced hiring or even reductions in force, causing unemployment to increase. Now there are less jobs than people to fill them, and wages then go down or at least flatten out. So the whole idea of FOMC intervention comes from creating this equilibrium, where both inflation and unemployment are low, but not so low as to cause a swing back in the other direction. The ideal employment level is called the non-accelerating inflation rate of employment, or NIRU. This is the level at which inflation is neither rising nor falling. FOMC doesn't officially publish a NIRU figure, but does maintain a projection for the long-term unemployment rate. This can be considered the level of unemployment at which the Fed believes inflation remains stable. The latest reported number for this is 4.2%. So what is the unemployment rate right now, and how exactly is it defined? The unemployment rate is defined and measured by the Bureau of Labor Statistics, or BLS. The official reported unemployment rate is currently at around 4.3%, which is about what they expect long-term unemployment to be. You can see where COVID caused a brief but accentuated recession, and the unemployment rate went back to its prior level within 2 years. It's been below 5% since late 2021. This 4 to 5% range is generally considered stable, meaning both low and sustainable long-term. This gap that you see was due to data not being collected during the government funding shutdown in October 2025. This is a risk to the unemployment rate data accuracy. So what happens to the unemployment rate when FOMC adjusts the federal funds rate? In this graph, you can see how the two rates often move inversely to one another. This is the intention of the rate change, but may have unintended future consequences. For example, when there are massive spikes in unemployment, you can see where the Fed instated a zero interest rate policy, or ZIRP, intended to bring maximum stimulus to bring unemployment back down. These regimes can lead to overhiring and subsequent reductions in workforce. The data for this number comes from the BLS's Current Population Survey, or CPS. This is also known as the Household Survey. This data is used to make a set of what's called measures of labor underutilization. There are 6 of these, numbered U1 through U6. U1 is the narrowest measure and only includes persons unemployed 15 weeks or longer. U2 are persons who have recently lost jobs or have completed temporary jobs. U3, also known as the official unemployment rate, is the total number of unemployed persons who have actively sought work in the past 4 weeks. U4 is everyone in U3 plus discouraged workers, or those not seeking work due to lack of job options. U5 is everyone in U4 plus marginally attached workers, or those not seeking work due to personal reasons. And finally, there is U6, the broadest measure of unemployment, which is everyone in U5 plus part-time workers who would work full-time if possible. So how does U3, the official unemployment rate, vary from U6? We can look at the same Fred graph from earlier, but with U6 added on. U3 is at 4.3%, and U6 is at 8%. So why is this significant? It means there are nearly double the number of people in a disadvantaged work situation, or those who are not getting the level of work that they desire, than is reported in the press or cited as an official number. Now we've looked at the data from the household survey, but there is another metric heavily referenced in official labor market numbers. This is the Current Employment Statistics, or CES. This is also referred to as the Establishment Survey, or the Payroll Survey. The main number the CES produces is the monthly change in non-farm payroll employment. As this chart shows, the latest number for April 2026 is officially at 115,000 new jobs added. This number was positively received by the financial press, as most estimates were lower due to cooling in hiring conditions. This non-farm payrolls number has been known to be revised after initial publication. The reason for this is the data officially stated is not the full data set surveyed. The BLS has to choose timeliness over accuracy when giving the initial number, which is then modified when new survey data is received after. Another cause of revisions is the use of net business creation estimates, which have highly overstated job growth in initial numbers in the past. This methodology has been updated, and the expected result is lower estimated numbers, but also more modest revisions in the future. These two numbers, the monthly unemployment rate and change in non-farm payroll employment, are broadly cited and are likely the most impactful labor statistics in terms of media coverage. They are the primary outputs of the BLS's monthly report called the Employment Situation. This can be taken as an overview of the labor market as a whole and is often treated as the de facto state of the labor market by many parties, including not only the media, but businesses and government agencies. There are some important caveats to note before using the data from this report. The CPS and CES surveys are conducted independently using different samples and methodologies, so their estimates can diverge. There are margins for error, as some changes in monthly payroll and unemployment rates may not be deemed statistically significant, and thus not included in the numbers. Data is often preliminary and subject to revision. Perhaps the revisions will shrink over time, but they are inevitable to a certain extent. Bureaucratic operating conditions can also impact the data. It's been reported that BLS staffing is down 20% since 2010 and have had a large number of leadership vacancies. Then, of course, there's the lack of funding for surveys during government shutdowns, when the data simply goes missing from the models and averages. Low response rates can impact the reliability of initial estimates. The official unemployment rate excludes unemployed workers not actively searching or who have dropped out of the job market entirely. Job creation from new businesses is estimated as it cannot be directly sampled. And finally, the legal status of workers is not identified or estimated. Due to these caveats, plus factors entirely unseen in the overall metric, the current rate of 4.3% unemployment seems misleadingly stable. While this rate has been fairly steady in recent years, it masks the underlying weaknesses that you can empirically witness. For in reality, we are seeing a general condition of lower job openings, more people dropping out of the labor market, and workers who are staying in their jobs longer due to fear and lack of options. In the next videos, we will take a closer look at these issues and provide a bigger picture of data sources and types. We will also look at state-level labor markets, layoff trackers, and public companies that publish data. From this, we can examine these findings and determine a bit better what the current state of the labor market is and how it got this way.